Good morning, good morning. Wishing you a wonderful Wednesday ahead. Welcome to today's episode of Morning Well. We talk about three things. Big tech strikes back. What's happening in the Chinese stock market? US CPI numbers out today. What to expect? Treasury yields retreated on Tuesday and technology shares rallied, reversing the trend of the past few weeks in which expectations for higher growth and inflation have favored cyclical names over high-value tech companies. US 10-year yields fell back about 6 basis points to about 1.53. The S&P gained about 1.4%, but the real action was in the Nasdaq, which ended the day up 3.7% off its highs earlier Tuesday afternoon. Among the session's big gainers were Tesla, which was up almost 20%, chipmaker Nvidia was up 8%, and Twitter was up about 6.4%. Investors appeared to bargain hunt, pouncing on stocks that had been beaten down over the past several weeks. Tesla shares, as I mentioned, was up 20%. Roku was up about 10%. Square was up about 12%. Big tech stocks also rallied. Apple was up 4.1%, Amazon 3.8%, and Facebook was also higher by 4.1%. Yet, if you take a step back and look at the broader reflation trend, favoring higher rates in cyclical industries also remains intact. So far this year, the Nasdaq is up just 1.4%, while the S&P 500 Industrials is up about 5.8%, and the financials are up at 14.4%. Crude, which is WTI crude oil prices, are up about 31.6% year to date. Moving on to an understanding of what's happening in the Chinese stock market, a world-beating rally in Chinese stocks has turned into the biggest rout globally, shocking investors with the severity of its reversals and evading state efforts to slow the pace of losses. In just 14 trading days, the nation's benchmark, which is the CSI 300 index, has come down 14% from a 13-year high. That compares with a 3.3% drop to the MSCI All Country World Index. The plunge has wiped out almost 1 trillion of value and hammered the holdings of retail investors who piled in at the peak, betting that the new Lunar New Year of the Ox or Bull would be auspicious. State intervention yesterday briefly arrested the tumble before losses resumed. The question on traders' minds now is how far the slump will go, given the CSI 300 is only a couple of bad days away from entering its first bear market in 2 years, and whether authorities will do more to calm sentiment. The hand of the state has become less obvious since 2018, when the government reportedly liquidated a handful of mutual funds it had formed 3 years earlier to purchase stocks during a crash. But the government has long acted to ensure China's financial markets are stable, especially around key events. The ongoing National People Congress, a closely watched political pageant used to unveil major policy priorities, is one such occasion. To see such turmoil in markets while the NPC is in session is highly unusual. The last time the CSI 300 lost more than 1% during the annual event was in 2014. And the current pace of losses would be the biggest since 2008. State-backed funds, known as China's national team, quote-unquote, stepped in yesterday in order to ensure stability during the MPC. This is according to what has been reported in Bloomberg. The efforts were initially successful. The CSI 300 erased a 3.2% drop to gain 0.3% in just over an hour in the morning trade. Yet the index renewed its decline in the afternoon to close down 2.2% at its lowest level since December, a move that stood out against an upbeat day in global shares. To be sure, authorities had in some ways encouraged the recent correction. Officials repeatedly warned of asset bubbles and said that curbing risks in the financial system was this year's key policy goal. Their comments came as signs of speculative activity increased. Liquor maker Quecha Motai, for instance, had surged 30% in just over a month to be worth more than 500 billion, making it one of the world's most valuable stocks. Yet, in a country where the government is paranoid about control and stock market is a tough beast to harness, rallies tend to morph into manias and declines have a habit of spiraling out of control. That suggests that more measures will be taken to prevent the rout turning into a panic in a year where the Communist Party will celebrate its 100th anniversary. This is some excellent analysis that I read out of Bloomberg, which I thought I'll share over here. Lastly, Consumer Price Index is scheduled for release today. Report is widely expected to reinforce everyone's concerns about inflation. I remember the whole of last year we were not bothered about the CPI print at all, and suddenly all of us have become so clued on to what the CPI report is going to come out to be. Between Jan and March of this year, 10-year Treasury yields have risen from 0.95 to a high of 1.6, and this alarmingly fast move was driven entirely by inflation expectations. The economy is improving, interest rates are low, and many investors believe that the rise in commodity prices will translate into a broader price increase. This could in turn force central banks to review their policies and reduce stimulus earlier than expected. The Federal Reserve says that it won't be the case, but based on the rise in yields and the US dollar, investors seem to think otherwise, at least for the time being. That's the update. Stay safe and healthy, and speak to you tomorrow.